Hello, everyone. Just wanted to thank you for joining us. We'll give everybody a couple more minutes to trickle in, and we'll get started then. Thank you for your. All right, I think we can get started. Thanks everybody for joining us today. Just a couple of housekeeping items here. If you have any questions, please use the panel, the GoToWebinar panel, to put your questions there. And just to let you know, at the end of this webinar, we will be sending out a recording. Again, appreciate everybody joining. I'm Tawab Abawi with Agile, and we're very excited to bring you two of our panelists today. Chris Maloney, he's the Vice President, Mortgage Strategist of BOK Financial Capital Markets. He's a wealth of Wall Street experience. Last 10 years before joining BOK Capital Markets, he was on the Bloomberg desk, and he's well published. I'm sure you've read a lot of his commentary and write-ups, along with our other panelist, Lyngen, who's the head of U.S. rate strategist at strategy at BMO Capital Markets. So both of you guys, we really appreciate you guys joining us today. We appreciate the comments you put out, and I'm thinking that a lot of people are going to get a lot of things out of this conversation today. So the main topic we want to kind of jump into is the Fed. Last week, jumped and they raised the Fed funds rate by 25 basis points. Wanted to get your input on what you thought about that, and then also. In my opinion, I heard some dovish and some hawkish sentiments. So I wanted to get your opinions on what you guys thought about what the Fed did.
Ian, you would like to lead off, or shall I?
I'll yield the floor to you, Chris. Why don't you kick it off?
All right, thank you. Well, I think it was all in all, I think it was dovish in a hawkish way. I think is the best way to put it. If you looked at Powell in his presser afterwards, I think the presser was more important than the statement. The statement was rather boilerplate, though Powell did refer to dropping the line about additional policy firming may be appropriate. He referred to that as a meaningful change, and it certainly is. But I believe it's more of an indication that they're closer to the end of tightening than they are to any rate cuts. I don't believe any rate cuts whatsoever are coming soon. The reason I believe that is the Fed's been adamant about a few things. One is that they've learned the lesson of the 1970s. If you look and you go back to poor sad Arthur Burns was the Fed chair back in the 1970s, he switched direction 13 times. Every time inflation started to fall off a bit, he'd excitedly start cutting rates again. And all Fed officials, not only Powell, have been adamant they are not going to make the same mistakes. So we're going to be higher for longer, to steal a phrase. And they also talked about, they know there's a lagged effects to tighter policy. Takes 12 to 18 months before it shows up in the economy. When you ease policy, it tends to have an effect much more quickly than it does when you tighten. Now, in Powell's presser, he constantly reiterated we're getting back to 2%. He talked about his 2% inflation target 15 times during the presser. In his recent Humphrey Hawkins testimony, I believe he talked about it 7 times. Earlier today, you had New York Fed President Williams. He referred to the 2% inflation targeting. They do want to get back there. They're not going to cut before the end of the year, and they're correct in this attitude. I mean, we just had an easy money period, which is probably the biggest we've had in our history, and it's time to soak up some of that credit.
Chris and I are very much on the same page when it comes to our interpretation of what the Fed delivered. I will put a little bit of a different context in it. Specifically, I think that there's a very significant mismatch between the timeframes with which the Fed is approaching the current situation and the time frame that market participants are viewing it in. The Fed has been engaged in establishing credibility as an inflation fighter over the course of the last, let's call it 40 years. If we think about where the Fed was in the mid 80s, when they were setting the overnight rate, they wouldn't even tell us what level they wanted it to be. Fast forward to today, we now not only understand the corridor for the level, we know the programs that are in place on either side, whether it's the RRP or interest on excess reserves, to make sure that the Fed is able to execute on that number. And we know what they expect it to be at the end of next year, the year after that. And they're even messaging, whether they're right or not is a question open for debate, what they anticipate it will be over the long run, i.e., let's call that the neutral rate. And within that period, they've ramped up communications in such a way that the market believes that they have a true understanding of the Fed's reaction function to higher than expected inflation, slower than expected growth, or a spike in the unemployment rate. What happened in 2022 was the Fed lost credibility as an inflation fighter, and now Powell is playing catch up to make sure that the market has the needed degree of confidence that the Fed is going to be able to re-anchor inflation or reestablish inflation expectations going forward. And that's why I think, as Chris pointed out, the removal of the forward guidance language about future rate hikes being appropriate within the statement was something that Powell reiterated, because that was effectively saying, listen, we are right up against the end of the rate hike cycle. The Fed is arguably shifting into data dependent mode, but in March, with a dot plot in the SEP, they told us that that terminal for this cycle was going to be 525 because they had the effective of 510 with some perceived wiggle room if inflation ultimately ends up being stickier than expected. What I think will be the biggest unknown, and we're grappling with this both as a market, and I'm sure monetary policymakers are as well, is what is the dislocations in the regional banking sector and the associated tightening of credit standards worth in terms of Fed hikes. We went into March's meeting thinking that the SEP or the dot plot would be increased by 50 basis points for terminal. In fact, the fact that it wasn't increased at all is being read, whether this is appropriate or not remains to be seen, but is being read as Powell thinking that the tightening that's going to come out of the events of Q1 is worth roughly 50 basis points. As we progress through the year, what we will learn is how accurate that estimate was, and if in fact they need to push a little bit higher, or there's a scenario in which they need to recalibrate slightly lower. A final point that I would make about the recent experience with the Fed is that as a market, we love to look at Fed funds futures pricing. And what we see is that by the end of 2023, the market is assuming 50 basis points worth of rate cuts. Now, it's very tempting to look at that and say, well, that's 100% confidence that the Fed will ease by 25 basis points twice sometime between now and the end of the year. I'll offer a different interpretation. And our interpretation is that what we're seeing reflected in the futures market is a 25% probability that the Fed needs to hike by 200 basis points, or excuse me, by cut by 200 basis points by the end of the year. And I think that that's very consistent with the binary risks that are facing the economy. Either the Fed gets us into 2024, which is our baseline assumption, or something goes horribly wrong in risk assets, higher unemployment rate, et cetera, and the Fed is forced to come back closer to neutral by the end of the year.
Chris, you mentioned easy money. QE4 was the predominant factor for the record low mortgage rates that we had. Now that the Fed has raised 500 basis points, can you elaborate on how that's affected the agency bond market for us?
Well, first and foremost, without a doubt, it's a lot of investors who purchased mortgage bonds in the past 2.5 years are looking at a sea of red of unrealized losses. And it's, the 500 basis point increase in a little over a year. I believe that's the fastest the Fed has done such a move in its history. And they really pulled the rug out from under the feet of a lot of these bondholders, and it's funny where the market and the Fed are in a disagreement on what the Fed is going to do through the end of the year. The Fed's saying we're not going to cut. Investors are saying, yes, you are. And after 500 basis points, I would imagine that Powell's established some credibility. I mean, after you punched me in the face once, I believe you're going to do it again at this point. But I could also understand why investors feel the way they do, because for the past 15 years during the QE era, every time the markets hiccup, the Fed has come rushing to the market's aid. You can only do that when inflation is not a problem. Inflation is a problem right now. So I don't see a rate cut to save everyone who's sitting on the sea of red with mortgages right now. So you've seen spreads blow out, prices go down in mortgage bonds. We have 30-year current coupon spreads right now are 3 standard deviations above their trailing 5-year average. But the problem is, after you've gone through QE4 was an absolute monster compared to everything that all the other QEs that came before. And one of the problems with easy money is it distorts prices. So even comparing things now to the trailing 5 years, the period of QE4, are those real prices? It's kind of hard to say that they are. And all easy money really does, and it's happened in the mortgage industry, is it simply pulls demand forward. You get to eat tomorrow today. Now tomorrow's arrived and we're walking through the desert. You've seen mortgage services have seen their refinance business collapse compared to what it usually is. Because right now, if you look at American homeowners, 1/3 of them wrapped in the 30-year mortgages are paying 3% or less on their mortgages right now. 3/4 of all Americans wrapped in the 30-year mortgages are paying 4% or less on their mortgages. When are they ever going to refinance? When are rates ever going to fall that far again? It's going to be years before the market normalizes again. And you don't see this issue just on the refinance side. With the rise in mortgage rates, purchase applications are now at their lowest in 3 decades. On the bright side from all of this, in a manner of speaking, is mortgage bond supply is going to drop dramatically compared to the go-go years of 2020, 2021. If you look at the half-decade prior to QE4, annual gross issuance of agency mortgage-backed securities is approximately 1.3 trillion a year. QE4 sent gross issuance to more than double that, to 3.3 trillion a year in both 2020 and 2021. So this year I expect 1.1 trillion gross, about 300 billion net, and there's risk to the downside on both of those numbers. Now, however, with all of this, you still have the Fed is allowing QT to roll off on its balance sheet. That's about $10 to $12 billion a month, which private investors need to absorb. And now the FDIC is the proud owner of billions of agency mortgage bonds, which previously belonged to banks. That's going to be about $7 to $8 billion a month through towards the end of the year, which also private investors are going to have to absorb. So right now, QE4 had its way with the mortgage market, and the mortgage market has quite at least a year or two before we get back to anything approaching normal.
Ian, I want to talk yields. How long can nominal treasury yields trade below effective Fed funds?
Well, that's one of the big questions of open for debate in the market at the moment. Historically, when we look at a moment when the monetary policy officials are pushing towards higher rates, i.e. a hiking cycle comparable to what we're arguably still involved in, what has typically happened is that typically effective Fed funds has functioned as a floor for nominal rates, meaning not only were 2-year yields rarely seen drifting below effective Fed funds, but that was also the case further out the curve, 10-year yields in particular. It wasn't until Greenspan's period at the helm of the Fed that we saw 10-year yields dip below effective Fed funds at a moment when there was a decidedly hawkish policy stance, and that was characterized appropriately as Greenspan's conundrum. The situation that occurred was there was this perception that the Fed had lost the tools to effectively deal with nominal rates further out the curve. I recall at the moment plenty of calls about the Fed had, quote unquote, lost control of the bond market, lost control of 10-year yields. That was Greenspan's conundrum. Powell's conundrum is that 2-year yields dipped below effective Fed funds while the Fed was still hiking, which is a true rarity, and I will say clear evidence that one could argue Powell has lost control of the front end of the market. However, the big caveat brings me back to the earlier observation that I've made about the different time frames that market participants are operating on versus what the Fed is worried about. When we think of nominal 10-year or nominal 2-year yields, we think of nominal 2-year yields as nothing more than a rolling 24-month window of monetary policy expectations. And so we can actually see a path for 2-year yields to end this year below 3% as the market looks forward to 2024 and 2025 and all of the rate cuts that we presume and have been told by the Fed will ultimately materialize there. And that means that from the perspective of the shape of the yield curve and nominal yields, this year's big macro trade is going to be the cyclical re-steepening of the yield curve. It hasn't occurred in 2s, 10s yet, although 5s bonds is already on its way back to, let's call it 50 and then eventually 100 basis points. But at negative 50 basis points, 2s, 10s has remained as stubborn as the Fed has been hawkish. And eventually that will pivot, but our argument is that it's still a bit too soon to expect that. That won't really come on the radar until we're well into the second half of the year.
So what effects has this had on the housing market? With rates increasing, should we be worried about a widespread housing crisis, decline in property values? Can you touch on that?
By nature is why I work in fixed income. I'm a worrywart. It's my job. But one thing I do not worry about is a collapse in housing prices to the extent we saw after the great financial crisis. And there's a number of reasons for that. Despite new and existing median sales prices rising to new records during QE4, I mean, that's not really surprising because QE4 poured $3.1 trillion directly down the throat of the mortgage market. That sent the 30-year lending rate to a record low. It's about 2 3/4 for a 30-year lending rate back in January 2021. But I referred to what happened in the housing market as a rich man's housing boom. Unlike in the last housing craze we saw in the early part of this millennium, when you can get a mortgage just by fogging a mirror, this time credit standards remain tight. If you look at the increase in gross issuance in agency mortgages, the Ginnie Mae guaranteed side, which has your lesser well-heeled borrower, went up maybe 50% from January 2020 to its QE4 peak. Whereas on a conventional side, with your better heeled borrower, it rose almost 140%. That's where your main growth was. Credit standards stayed tight. If you look at debt to income ratios and FICO scores, they moved sideways during QE4, which is a good thing. The mortgage lending industry should be congratulated on its behavior this time around compared to back in the earlier part of this millennium. If you look at the Mortgage Bankers Association's credit availability index, they collapsed in March 2020, and they stayed low throughout the entire housing mania. And that's exactly what you should do when you're in a housing mania. As a lender, you need to have the courage to be fearful when everybody else is running around talking about how everything is coming up rainbows and lollipops. You need the ability to step back and look at the dark side of things rather than the bright side of things. So I don't expect a huge deluge of foreclosures like we saw at the end of the great financial crisis, because people in their homes now actually deserve to be in their homes. On the other side also, there's absolutely no inventory out there. The QE era has been an absolute disaster for single family home building. I don't use that word lightly. From 2010 to 2019, the average rate of single family home building in this country fell to less than 700,000, easily the lowest of any decade since the 1950s, and it's averaged 1.1 million over that time period leading to QE4. So bottom line, between the people who are in their homes actually deserving to be in those homes that can afford it and the lack of inventory, that will help to keep a floor under home prices. On a national basis, I expect home prices to either stay unchanged or fall about 5% nationally by year end, but I don't expect a housing price collapse.
That's good to hear. Wanted to talk about money supply. Four straight months decline as measured by M2. Is the Fed tightening too fast, too much? What are the potential impacts of that, of a declining money supply?
Well, when I think about money supply and the prospects for the Fed over tightening, I'm reminded of the period following the great financial crisis when we did see money supply initially increase, move sideways, drift a bit lower, but the real story was the outright collapse of the velocity of money. And the velocity of money ended up trending much lower, as it has recently, because of increased tightening on the credit side, so harder lending standards, higher lending standards, and a wholesale increase of regulation that followed the great financial crisis. Drawing the parallels to what we're seeing today, there is that elevated degree of uncertainty regarding what's going to follow the turmoil seen in the regional banking sector and whether there's more regulations on the heels of that, and what that translates through in terms of a even greater decline in money supply or a further deceleration in the velocity of money. All of that being said, the Fed has tightened very quickly, and it's not only the Fed that's been hiking. If we look globally, the Bank of England, the ECB, the Bank of Canada, all of the, with the exception of the Bank of Japan, all of the major central banks have tightened as dramatically, perhaps not to the same terminal level, but certainly at a comparable clip to what we've seen from the Fed. And that cumulative tightening impact is bound to have a detrimental fallout to the global economy. And that's what actually has me very much concerned about the next 6 to 8 months.
I would have to agree that it is a concern to see the money supply go negative. I mean, the problem with inflation that I have with the theory of inflation targeting, which guides the Fed, is that it specifically repudiates the idea that inflation is a monetary phenomenon. Now, what is a recession? All a recession is a sudden rush of everybody looking to get liquid. If the money supply is falling, there's less that people can have to pay back their debts when a recession hits. You know, M2 year over year, I believe, was down 4.1% annualized in the latest release. Now, unfortunately, if you want to get back to your 2% inflation target, you either need to push the supply of money and credit lower, because that's where the inflation and prices come from, and the money supply grew by 40% during QE4. No economy needs a 40% increase in the money supply in that amount of time. You can either do that, or you can try to hold the money supply steady and let the economy grow up to the dramatically increased level of money that you now have in the economy. Now, that's happened before. After the Civil War, the US government went off the gold standard during the Civil War. They dramatically inflated with what the paper money was called the greenbacks. And rather than withdraw all of that and collapse the money supply with all the attendant problems, they just held the money supply steady as much as they could, and they allowed the economy to gradually grow up to it before they could go back on the gold standard. That's probably the best thing the Fed could do now, why I believe they'll pause at 5.5% and just step back and hopefully let the economy grow up to the new money supply. You really don't want your money supply to collapse. You know, everyone says, you know, I'm not saying there's a Weimar Republic, but everybody says Hitler came about because of inflation. No, he didn't. Hitler came about because of the deflation that followed the collapse in 1929.
Interesting. Well, so with that said, what would cause the Fed to pivot, and how would that impact the mortgage industry and the mortgage market?
Well, maybe I'll take the Fed pivoting potential. When we worry about the next inflection point for monetary policy, we tend to look at it in terms of overall financial conditions, not necessarily what we're seeing in terms of real GDP or even the unemployment rate. The worst case scenario for the Fed is obviously the unemployment rate increases above 5.5% up to 6% at the same time that the realized inflation data is coming nowhere close to target. But setting aside that outcome, I think that the more realistic driver of a Fed pivot will come in the form of a sharp increase in realized equity market volatility, and the VIX only spikes when stocks are selling off. And so that brings us back to whether or not there exists a Powell pivot a Powell put in the current environment. And I would say that exists, but it is struck a lot lower than market participants believe, because the Fed has already signaled that they're willing to see a lot more excess demand destruction than the market appears to be ready for. And so that means a steady, slow decrease that's measured of the S&P 500 comparable to what we saw in 2022 is an environment that the Fed would consider, frankly, a win, because it's not associated with a spike in volatility. It doesn't tighten financial conditions, but a sharper increase in realized vol on the equity side, combined with wider credit spreads and a wholesale de-risking, that's the inflection point that I think will get the Fed to pivot and start the conversation about fine-tuning rate cuts. Whether they are ultimately end up being more or not remains to be seen. Again, we don't think that's this year's story, but it's certainly something that does need to be considered as we think about the second half of the year.
I agree. I believe it's really three things which can make the Fed pivot. One, the Fed was created in order to prevent a financial panic, not a financial downturn. So I agree that if you see volatility spike higher and there is a panic, will they step in? Yes. War is another way. If we get into a war with a peer competitor, the job of the central bank during a war is to fund the government, come what may, forget about inflation. You saw that in World War I, World War II, the Vietnam War. You had LBJ pushing the Fed chair up against the wall to make sure he didn't raise rates. So those two things, without a doubt. Last is the state of the banking system. If you look at the Fed's financial stability report, they give 5 key functions that they list as the Fed's reason for being. 3 of those 5 functions directly involve intervening to protect the banking system. Now, the idea behind why they have to do that is laid out really nicely in Ben Bernanke's book, Essays on the Great Depression. He calls it the cost of credit intermediation. Basically, it's a cost of banks taking money from savers and moving it on to good borrowers. Anything that disrupts that flow creates a contraction in the banking system and economic dislocations, even though he admitted also in the book in a footnote that his is basically what he called the cost of adjustment argument. In other words, it's a pain in the neck to let banks collapse with all the attendant problems. Why not just bail them out? But the problem is, if you let loose the dogs of inflation now to pivot back to an easy money policy, when inflation, looking at CPI, is still at 5%, that's going to cause interest rates to move higher. And that would exacerbate the very issue the Fed is grappling with right now, the unrealized losses on bank security holdings, in particular their mortgages. And it would increase mortgage lending rates as well and hit the housing market. So the Fed's really between a rock and a rock. And the current stance of the Fed speaks to the wisdom of why Powell has that current stance. And they've been adamant about this. Inflation comes before everything else. Unemployment, economic growth, etc., means nothing without getting inflation back under control. But for the three reasons we just spoke about, they would go back to an easy money policy.
Got it. Ian, you touched on the 2s and 10s for a little bit there earlier. Assuming the Fed doesn't pivot, doesn't cut, what happens to that curve?
That's one of the things that we've been pondering, because I am on board with the idea that 2-year yields can trade deeply below effective Fed funds as long as the market is convinced that 2024 and 2025 will see significant rate cuts. When we think about the outright level of Fed funds at the moment, or if we get another quarter point hike by the end of the year at, let's call it 550, that means that we're using the Fed's own estimate, 300 basis points into restrictive territory. When you combine that with the balance sheet runoff that will be in place at that point, and presumably well into critical mass, that's a significant amount of tightening. So even cutting by 100 basis points next year still leaves policy in restrictive territory, but the market will be content to err on the side of assuming that those rate cuts are larger rather than smaller, and that will keep a curve steepener in play, even if we don't see anything from the Fed through the first quarter of next year. Now, obviously, we're not going to get the big bull re-steepening that puts positive 75 or 100 basis points on the table until the Fed actually does begin the process of cutting or signals that it's right on the edge of doing so. But there's very little chance that we retest the cycle lows in 2/10 of negative 111 basis points. And in fact, anything beyond negative 75, we'd look at as a great opportunity to reinitiate steepeners into the end of the year.
Kind of wanted to shift gears on obviously a big topic that's going on in all industries, but the sector that it affects our mortgage industry, but it's all over CNBC, all over the news, the regional banking crisis. How worried should we be with what's going on in that sector?
If I could start, under the caveat that I'm not a banking analyst, any bank crisis, they tend to be slow-moving affairs. If you remember, Bear Stearns went down, I believe it was March of 2008. Lehman Brothers, where I worked, it didn't go down to about 6 months later. That was September 2008. So if I had to guess, and this is a pure guess, probably not out of the woods yet, but any forecast of how bad it's going to be or how much of a tightening that credit restriction would cause, I wouldn't even try. I'll let Ian do that.
Well, I'll say that I certainly agree with the notion that it's going to be a slow-moving process. What the Fed has done, however, is after the financial crisis and after Bear Stearns and after Lehman, they put into place a variety of what they've called macroprudential policy tools or financial stability tools, which include attempting to take some of the stigma out of the usage of the discount window. And now, as recently as March, they introduced a new bank funding facility to provide liquidity into the system that's much more targeted than either QE or rate cuts. And I think that by separating the two, monetary policy being designed to impact inflation and unemployment, whereas financial stability tools are really there to address the overall system. They've given themselves enough of a runway to remain restrictive and continue the battle against inflation, while at the same time ensuring that there's not a complete collapse of the banking system, and do their best to contain the bank runs or the mini bank runs that we have seen. Nonetheless, I'm very much in the same camp as Chris, insofar as I do think that there is more downside yet to be realized. And one of the things that comes up quite often as I make the rounds and talk to clients is what this might all mean for the commercial real estate sector, and if there's going to be any knock-on effects if we're able, or if the Fed is able to keep rates as high as they are, and we don't see any pivot. And I'm certainly not an expert on that sector by any means, but I will say the best outcome for commercial real estate would be a Fed that gives up the fight against inflation and errs on the side of lower rates sooner rather than later. And barring that, we might see the contagion that started in the regional banks push into pockets of the commercial real estate world.
All right. With that said, what's more likely, the FDIC raising the 250K limit, or the Fed pivoting and trying to combat the crisis that's going on right now?
I would like to think that in a perfect world, the FDIC would be willing to take a hard look at the realities of inflation and what that has done to that $250,000 limit, the amount of cash that's in the system, the amount of cash that people have. My concern is not dissimilar from the issues that Congress is dealing with at the moment in coming up with some type of consensus around the debt ceiling. That there's a lot of political discourse or discord in Washington, D.C. at the moment, and that does suggest that from my perspective, I think that the severity of the contagion within the banking sector that would actually need to occur to get Congress to move on the FDIC limit would be comparable to the severity that it would take to get Powell to really consider a fine-tuning rate cut. So in a perfect world, FDIC should go first. That should be accompanied by an acknowledgement on the part of lawmakers that that limit needs to be adjusted for everything that's occurred over the course of the last several years. But I think in reality, it's going to be a much more contentious process.
All right, Chris, anything there? Good?
No, that's fine.
All right, so now for the million, or I should say the billion-dollar question. Everybody's here to wonder, how should mortgage investors or originators, lenders, how should they position themselves for the rest of 2023?
I prefer mortgage bonds over investment grade corporates. It's due to the lack of credit risk in the former, and there's a lot of red flags out there for the economy. You know, do I believe there's going to be a recession? I think there's a very good chance we could see one, and that's when the credit risk-free nature of mortgages comes to the forefront. If you look at the investment grade corporate index, I believe it's half BBB at this moment. And in times like these, not having any credit risk helps you sleep better at night. Within mortgages themselves, I prefer an overweight to shorter duration paper. If you look at the shape of the yield curve, what is it telling you to begin with is stay short. I mean, we're entering a period of tighter credit for the economy overall. You know, at this time, conventional 15 years, they look cheap to their trailing 5-year average in both an OAS and nominal spread basis. And more importantly, their supply has absolutely collapsed, not just in 15 years, but in all short duration paper, whether it's 10, 20, 15 years, compared to the drop in longer paper. If you look at the year-over-year collapse within your shorter amortization paper, it's been between 90 to 95% across the board for your different types, your 10, 15, 20. If you look at the 30 years, Ginnie Mae's only down about 50%, Fannie Mae's only down about 70%. So I don't think this is going to change anytime soon, because your shorter amortization paper is mostly created via refinancings. Refinancings are going to be a very rare bird through at least the end of this year.
I tend to agree with Chris that the mortgage market at this moment, given the backup in spreads, given all the dislocations that have occurred, is an attractive opportunity, especially assuming that we find ourselves in a recession that is either a version of a soft landing or a medium landing. I think that is a scenario in which credit spreads on the corporate side and high yield side will continue to widen as we see defaults that the monetary policymakers are unwilling to address start to increase. My concern is that the recession ends up being closer to a hard landing and a lot more significant. And that's an environment in which eventually the Fed could, as it has so many times at this stage, need to step up and be the buyer of last resort for a variety of different products, including but not limited to mortgages and credit. So I would say being reasonably allocated towards mortgages as the process starts, but keeping a bit of dry powder in case things get much worse, because if they get much worse and it appears that the Fed will need to step in, there'll be much more attractive spread levels at which to enter into investment grade and high yield.
Well, I mean, that's it for me. I really appreciate both of your guys' input, insight. We really want to thank you for joining us. I learned a lot. If there's any questions, please put them into the panel over there to the right. Otherwise, we look forward to seeing your commentaries and your write-ups. You guys are obviously very smart men, and we appreciate you and what you do. And I know right now is difficult times. Everybody's busy, so taking time out of your days and weeks to put this together. So thank you very much.
Thank you for having me.
All right, I think we don't have any questions, so we'll call it here.
All right.
All right. Thanks again.
Thank you.